All right, today we're going to break down one of the most important ideas in trading, something that really separates the pros from everyone else. We're talking about internal versus external market structure. Get this right, and you've got the foundation for everything we do in smart money concepts. So let me ask you a question. Why do your stop losses keep getting hit? I mean, you see a crystal clear support level, you put your stop just underneath it, you feel pretty good about it, and then what happens? Price just wicks down, takes you out to the exact tick, and then rips in the direction you wanted it to go, but without you. If that's you, it's because you're playing a game, but you don't actually know all the rules. Pay close attention, because what I'm about to show you is going to completely change how you look at a chart. You're not just going to see why your stops get hunted. You're going to learn how to see it coming and use it for your own profit. Welcome to SMC Foundations. Think like institutions. This is not a strategy series. This is not about entries. This playlist is designed to remove retail thinking and replace it with institutional decision logic. Okay, let's get right into it. To really understand how price moves, you have to get that there are two kinds of market structure playing out all the time. The easiest way to think about it is like this. There's the mountain, and then there's the path you take to climb it. So first up, you've got the external structure. These are the big, obvious swing highs and lows you see on, say, a daily or a 4-hour chart. These are the mountain ranges, the peaks and valleys that everybody can see. This is where almost every retail trader puts all of their focus. And, as we're about to find out, it's exactly where the traps are set.
But the real story, the one that actually matters, is told by the internal structure. This is the hiking path, the little twists and turns that price takes in between those big mountain peaks. While everyone else is just staring up at the summit, the smart money, they're down here looking at the footprints on the path. This is where you see what the market really intends to do.
And look, the difference between seeing just one of these versus seeing both, well, that's the whole game. It's the difference between thinking like a retail trader and thinking like an institution. It's a tale of two completely different mindsets looking at the exact same chart. So the retail mindset, it looks at the mountain peaks. It asks questions like, where is the obvious support? And then it puts a stop loss right there, which makes them 100% predictable. The institutional mindset, on the other hand, is looking at the path. They're asking, what is this smaller internal price action telling me about where the big money is really trying to go? See the difference? They're reading the footprints, not just staring at the destination. Now we have to talk about the psychology of why this is so damn important. Because those obvious external levels, they are not your friends. They are traps. And the bait they use is called liquidity.
Let's just walk through how the trap works. So, a retail trader sees a strong external low. Price has bounced off it 2, maybe 3 times. It feels like a brick wall. It feels safe. It seems like the most logical place in the world to put a buy order or to hide your stop loss.
And so what happens? A giant cluster of orders just piles up right below that safe level. You've got stop losses from people who are already long, and you've got buy limit orders from people trying to get in. It's just a big, predictable pile of orders sitting there for the taking. And this big, predictable pile of orders creates what we call a massive pool of liquidity. It basically acts like a giant magnet for institutional money. And here is the absolute key. Institutions, banks, hedge funds, they need liquidity. They have to fill enormous orders, and they can't do that without causing the price to skyrocket against them. That's called slippage. They can't just click buy. They need a huge amount of people willing to sell to them. Now, where can they find a giant, predictable pool of sell orders? Yep, you guessed it. It's all those stop-loss orders sitting right below that safe external low. So they will deliberately engineer price to push through that level. They hunt the stops. This triggers a flood of automated selling, which gives them all the liquidity they need to fill their massive buy orders at a fantastic price right before they reverse the market and leave everyone else holding the bag. But here's the flip side. For the trader who watches the internal structure, this isn't a trap. It's a huge opportunity. You can actually see the internal price action starting to get weak as it gets close to that external low. You can anticipate the liquidity hunt is coming. You can avoid putting your stop where everyone else does, and instead, you can get in at an incredible price, riding the real institutional move after the trap has already been sprung. So how do we actually put this to work? How do we go from just knowing this stuff to using it? It's all about systematically looking at the market through this new lens. Here's a simple framework to get you started. 1. Identify your external structure, your mountain peaks, on the daily or 4-hour to get your main bias. 2. Zoom in.
Go down to a lower time frame, like the 15-minute, and start analyzing the internal structure, the path. 3. This is key. Look for divergences. You want to see the internal momentum shifting before price even gets to that big external level. 4. Use breaks of that internal structure as your trigger to get into a trade. And 5. Place your stop loss based on an internal point that proves your idea wrong, not on the obvious external level that everyone else is watching.
Getting this down isn't just learning another pattern, it's a true foundational advantage. Once you understand the relationship between these two structures, everything about how you see the market is going to change. This is the edge you get. You get an information advantage because you're reading the story that most traders completely miss. You get a timing advantage because you're getting in before the real move happens. You get a risk advantage because your stop placement is so much smarter. And maybe the most important part, you get a massive psychological advantage. You stop being afraid of manipulation and you start expecting it. That right there is the path to consistency. Now let's do a quick recap of the key mental shifts. First, stop seeing obvious highs and lows as safe zones. See them as liquidity pools. Second, understand that external structure gives you context, but internal structure gives you timing. Third, your goal is not to predict, but to read institutional intentions through internal price action. So, I'm going to leave you with this one question, and I want you to be honest with yourself. Are you currently trading what's obvious, or are you learning to trade what's actually intended?
This course is built to correct execution mistakes, not to entertain. If this video removed a false belief for you, support the course, like the video, share it with a trader who keeps buying higher highs, and subscribe so you don't miss the required next lesson. This is SMC Foundations. Think like institutions. We build context first. Execution comes later.